this is Tim West. I am going to show you today all about time at mode, and this is a handcrafted methodology that I've come up with and named it time at mode. I can measure with reliable consistency and methodology the amount of accumulation or distribution that has occurred in any security on any time frame to determine how much time the security can then trend once the accumulation or distribution period is over. The very logic of this approach came to me in 1988 after I discovered Market Profile from a friend and floor trader on the Chicago Board of Trade, the CBOT. He made a living in the soybean pit, and he plotted the market profile there on a 15-minute time frame. So I started plotting markets this way and found a remarkable way to monitor markets and trends that has been uniquely powerful ever since. I had to plot my charts by hand since there was no software at the time other than the 15-minute time frame. I learned from Glenn Neely from NeoWave, who I studied under, that any method should work on all time frames if it is legitimate. So I set out to find larger patterns. My first hand plot was of the 1987 stock market to see what it showed, and it was fascinating. I'll have another video just on that alone. When you hand draw charts, you can see patterns that you don't see when you just look at a chart. And a main tenet of my methodology involves determining what time frame any market is operating in. What I found is that if there are more than 20 time periods at any one price, then that is when the market is telling you the current time frame is not strong and not in control. So the solution is to go to a higher time frame and make a new chart so that there are less than 20 time periods at one price. There will be more on that point later. So let's begin now at the beginning. I use a high-low close bar chart, also includes the opening price, and I count the price from the close if there is a gap. And you can see on the chart here, for example, from here to here, you want to include that price action. So the reason there is a gap from one close to the next bar is that there are so many buyers or sellers at the previous close that there weren't enough people on the other side of the trade to make a trade. So the gap is important to know about, and even more important to include on your graph. So same goes obviously for gap ups and gap downs. Here's how I define a trend, and it is very simple. Everyone has a definition of trend, and if you don't have one, you need to have one. It can be as simple as, is the price up today? Then it is an uptrend. People, again, have a million reasons, and I will show you my method here. A trend up starts the moment there are 5 bars without a new low. In this chart, the U.S. presidential election was a very large 5% down move, which isn't shown here. It happened in overnight markets. This low from the 4th of November, and these are 2-day bar charts, 2 days per bar, is where we begin the analysis. Clearly you can see the markets in a downtrend to here because the price is making new lows, etc. But given that there's no new lows for 1, 2, 3, 4, 5 bars, we can call this the start of an uptrend. So we begin it here. What we want to do is to look for a period now where there's quite a number of bars at one price. So we can see that there are 15 bars here at this one price. I've already drawn it in, but here it is again. We can count them. 1, 2, 3, 4, 5, 6. That one's not there. 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Notice what happens. A market will tell you that the trend has ended when you get a range expansion movement like this out of the mode. So this entire bar, not only is the entire bar above the mode, but this price range is greater than this price range. So the movement up is greater than the previous price range. You can see that graphically here. I can copy that range there and then grab and slide it up, and you can see that the market has advanced by more than this range. So that's how the market tells you that it's ready to rally in this case. And once the market's above this, we can call this accumulation, as I have typed out here. So I get back to my notes here. So this becomes bar number 1. We can just label it a number 1. And then we want to count from there 15 bars. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So that's why this yellow bar is here, and I can call that bar number 15. That's, interestingly enough, that's the highest low in this trend so far, and this is live as of April 2nd, 2017. So quite interesting. The trend begins here and ends here. We can also see that it ended here because there's no new high for 5 bars. So once we get past this bar, there's no new high. There can be now a downtrend, which I've marked here with this little red box to indicate that a downtrend started there. And you can see we're in a downtrend now. And so the additional point, there's in addition to the time dimension, there's a price dimension. So the fascinating part is you get a price projection by measuring the price range around the bars that touch the mode, and then add that to the range, add that range to the mode itself to get an upside projection. For example, we measure the price action from everything that touches the mode between the start and end of the pattern. Let's go to bright yellow. And this price range is the measuring stick, which we can copy and then place here so that it ends on 15. An easy way to do that is that it overlaps up to 1, 2, except 2 bars. 1, 2 don't touch the mode. So we just have it overlap 2 bars, and then that ends right there at 15. So here's where we expect the trend to top, and this is the upside price projection that we would look for the trend. If a trend is very strong, obviously you get double. You don't necessarily look for more than that, but there is one pattern where you can see 3 that I call an explosion pattern. So there is also a concept which is logical, a strength or weakness implication of the pattern. If this market, for example, is set to accumulated by 15 bars, if it can't rally for 15 bars, then that implies weakness. If it doesn't rally by the amount of the trading range prior to it, it is also considered weak. We can also do a calculation, a little more difficult here to do on the fly, but I would do the previous mode, which might be down in this area here, and measure from this mode up to this mode, and then copy that and have it repeat. And you can see that is a closer match. I don't know that this is exactly the mode, but it might be very close. It could be up here as well. Either way, that's for another video. There is another concept of a triangle. Imagine that there is an uptrend in place, as for example, the uptrend from here. At this point in time, there's 1, 2, 3, 4, 5. At this point in time, there is a downtrend from this high. So I can actually grab this and say, at this point in time, there is a triangle in place because we have an uptrend in place and a downtrend in place. And you can see that that is essentially what happened throughout this time frame, which is interesting. So markets don't always trend. They certainly don't all the time, or else everyone would be a gazillionaire by now, because you would just buy an uptrend and hold till a downtrend and everyone would make money. But that's not how markets work. Markets go to the price level where the most volume will trade. This is a very important point, and we'll cover many times in the charts in future videos. So I mentioned earlier about 20 time periods. Let's go over that again. Let's define when we know that there is no trend going on. This is simple. It is when there's too much time at one price. A trend fails to be in effect anytime there are more than 20 time periods at one price. So therefore, what you need to do is go up in time frame until you get up in time frame. Means to go from daily time frame to 2 days, or from 2 days to 5 days. So use a week per bar. And you want to get back to an ideal number of 10 periods at one price. But remember, not more than 20. It just means the market is taking too much time on that time level to show who's in control of the market. Control requires absorbing enough volume in the market to start moving the price. And every stock or commodity has its own time that it operates in. This way, we can listen to the market and let the market tell us what time it is in, and not forcing our analysis onto the market. So let's look at where we are today, April 2nd, 2017. And what we can see is that we're in a downtrend on this 2-day time frame. We have matched the power implications of the last uptrend, but we're currently in a downtrend. We're waiting for the market to balance itself out here. It has an uptrend from this low and a downtrend from this high in place. So we are technically in a triangle. And we're trying to let this downtrend that's in place off the high play out. Let's do some measurements real quick. Let's measure this range and project that down. And you can see that the market reached the low level target. The amount of time we can count: 1, 2, 3, 4, 5, 6, 7. There are 7 time periods at this at this price. And then we look at the range expansion that happened from here to kick off the decline. So that marks bar 1, 2, 3, 4, 5. We just have 2 more to go. So we'll see on later this week how the downtrend plays out. Could be that we then are closer to having no new low for 5 periods, and then we'll have 2 uptrends and 1 downtrend, and we can set up another uptrend. So that's very simply time at mode using the S&P 500 using a 2-day bar chart, since that's the time frame the stock market is on right now. And look forward to making more videos for you to help you get up to speed on time at mode. Thank you. Have a good day.